my sense is it's not going to happen. That we're probably going to see a very disappointing year. Add that on to the geopolitical tensions, and it's going to be, at best, a very volatile environment for investors.
But I think only half right, because it's actually potentially a lot worse than you're saying.
It won't be a government job, it'll be handouts. You have unemployment at 10, 12, 20%. Yeah, my thesis comes from two insiders that I managed to get hold of. I won't name them, but one was the director of a very well-known A1 company, and the other was is a co-founder and CEO of an A1 company. The former resigned because he didn't like what was coming, and the latter spelt out in a 10-page report, which I found on X, going through blow by blow, A1 is going to cut into the employment in a wide range of industries. And he quoted the story of a senior partner in a legal firm who is using A1 and is seeing how his number of employees are going to be cut dramatically. And then when I went through all of the 10-page report and the one paragraph that I pulled out of the other guy's resignation letter, I then picked up a comment from another insider saying we're going to lose at least, this is in America, 20 million jobs over a number of years. I then actually went through the sector by sector job employment and then linked that into what these two guys are saying. And I came up with 40 million. And 40 million not over 10 years, but probably over 3 to 5. And the consequences are not just on a society, they're on government revenues. 83% of government revenues comes from taxing employees and taxing companies on their employment stuff. So that's 83%. And if you're going from an unemployment currently, supposedly, though probably much higher, at 3% or whatever it is, up to probably 6% at the end of this year, and 8 to 10% next year, and God knows how much thereafter, that's going to be a big hole in government revenues. How are they going to match it? What are they going to fill it with? So it all comes back to the bond market, which is the Achilles heel of the American economy. The huge debt, it's not just government debt, it's debt of households, financials, and corporates. The total debt last year was 136 trillion, compared to a GDP of 30.6. So the massive problems ahead. And I think that it's unlikely we are going to see 2026 as the start of the next bull market or whatever. That economic growth is going to accelerate. My sense is it's not going to happen. That we're probably going to see a very disappointing year. add that on to the geopolitical tensions, and it's going to be, at best, a very volatile environment for investors.
Modern governments rely heavily on income taxes and payroll-related revenues. In the United States, a substantial share of federal receipts flows directly from employed workers and corporate payrolls. If large-scale job displacement occurs, that revenue stream weakens precisely when public spending must increase. At the same time, total U.S. debt, including government, household, and corporate liabilities, exceeds $130 trillion against GDP near $30 trillion. The imbalance raises a critical question. How does a highly indebted system function if employment income contracts? The answer likely involves more borrowing or monetary expansion, deepening structural vulnerability in bond markets.
Yeah, well, I mean, this is fascinating because if I look at it purely from an economic point of view, I mean, Simon's right, about the impact on debt. But I think only half right, because it's actually potentially a lot worse than you're saying. Now,
I left that for you to say.
well, we'll just throw a little bit of economic theory into this one. Many years ago, before John Maynard Keynes wrote his general theory, there was something called Say's law. Now, the basis of Say's law was that we produce things in order to buy other things. In other words, it is production that leads to consumption, not the other way around. Now, this is just really important. We now face a situation which, as Simon describes, where we're no longer producing to consume. So how, I mean, if we're not going to be paid to produce, if you like, then how are we going to afford to consume? Who's going to fill up the balance? When it comes to all this wonderful capital investment in manufacturing things without anyone actually being involved in the manufacturing process, it all being done by robots and all the rest of it, how is it that there is going to be a market if the consumers have absolutely no pay and can't consume? In other words, it fractures the entire economic model of the diversification of labor. That's the fascinating thing. Now, we'll find out whether Keynes was right about dismissing Say's law or not. So this is fascinating, if you like, from that sort of rather arcane point of view. But what it does mean is that if consumers are actually going to consume these goods without being paid to produce them, then basically they're going to have to be paid by the government, because there's nobody else to step up and give consumers, if you like, the wherewithal to consume. And the only way in which government can do this, basically, because they will have lost, as Simon points out, they'll have lost the majority of their tax revenue. The only way they can do this is print like fury. So, the whole thing is just going to collapse. I can't see any other outcome.
For centuries, economies operated on a simple principle. People produce goods and services in order to earn income and consume other goods. But advanced automation challenges that foundation. If machines and algorithms generate output while workers lose purchasing power, who becomes the end buyer? Some economists argue that governments may attempt to fill the gap through fiscal transfers or large-scale public employment. However, financing such programs in an already leveraged system risks currency debasement. History shows that when governments print to compensate for lost productivity income, inflation accelerates, often beginning in commodities before spreading more broadly.
It won't be a government job, it'll be handouts. If you have unemployment at 10, 12, 20%,
sure, that's
a lot of money that the government is going to hand out. If you don't hand it out, you're going to have a civil war.
Well, yeah. And if you hand it out, you trash the currency. I mean,
exactly.
You cannot win. You just cannot win. It's the end of the fiat currency system. And I think, as to Simon's point, most of us, I think, going into this year or going into last year in particular, probably thought this was going to take, we've got another 5 to 10 years sort of thing. But, this is fast track now. I mean, it really is.
Absolutely.
And when people wake up, they'll begin to realize why it is. I mean, it's interesting. I've got up, I don't know if you can get it up. You're very good with charts, Danny. The CRB index. I mean, it's tripled, basically, from the year 2020. It's tripled. Now, this is broad-based commodities. When you get commodities rising like that, what it's telling you is the purchasing power of currency which you're measuring it in for commodities as a whole is declining. Go back a bit further if you can. Yeah, you can see it. There you go. Look at that. I mean, it's got a lot of that move. Basically, is the debasement of the currency. That's what it is. Because we haven't seen, we haven't seen a sort of wonderful renaissance in manufacturing or anything like that, except perhaps in China, where they manufacture a lot more efficiently than we ever did. And that's a process which is going to continue. I mean, it's now breaking out. It's a fascinating where you've drawn the lines. I think that's valid, actually. Off to the races for everything. I mean, copper, which is Simon's speciality, I would have thought is in the van. And today we've got crude oil up at WTI is up at $66. Recently it was, 55, 56? So
well, that's probably because of what's going on with Iran.
Well, yeah, I don't disagree with that. But if that was serious, I think it'd probably be quite a lot higher. So, but the point is that the purchasing power of the currency, in this case the dollar, is declining at an accelerating rate. And this is going to be first reflected in commodities broadly, and gold is leading the van in this one. I mean, really. Then you've got the other problems. And I think, AI is a very, very interesting take on where we're going.
Commodity markets often detect currency stress before equities do. Since 2020, broad commodity benchmarks like the CRB index have surged, reflecting both supply constraints and declining purchasing power in fiat currencies. Gold has led much of this move, reinforcing its role as a monetary barometer. When investors seek insulation from currency erosion, precious metals tend to respond first. Meanwhile, energy and industrial metals have experienced sharp volatility, influenced by geopolitical risks and supply chain realignments. Rising raw material prices are not merely inflationary signals. They are indicators of shifting confidence in the global monetary order.
I think that over the next couple of months, 2 to 3 months, we're going to have a big correction in global equity markets. I think that will spill over into gold, silver, and the base metals. At the moment, taking copper as an example, the market is in heavy surplus and will remain in surplus this year. It's the money game that has pulled copper prices up to $13,500. I think we are on the way down to 7,000 by the end of the third quarter of this year. And then we will start a real 2-year enormous bull market, where we will see a final peak after a big correction in 2028. We will then see a top in the copper price of around, hold on to your hats, $28,000. But then if you convert that back into 2026 dollars, the price is $14,300, not too much different from today's price, because of, as Alistair says, debasement of fiat currencies, which leads us back to Alistair's forte, gold. What is the price of gold going to be in 2030, let alone in 2028?
Equity valuations remain elevated relative to bond yields, leaving markets sensitive to interest rate spikes. Should U.S. Treasury yields approach 5%, equity multiples could compress rapidly. In precious metals, attention has turned to physical supply dynamics, particularly in silver markets, where exchange inventories have periodically tightened. Cash settlement practices on futures exchanges have historically eased delivery stress, but sustained shortages could challenge confidence in derivative pricing mechanisms. While gold ownership still represents a small fraction of global portfolio allocations, institutional interest appears to be rising gradually, especially across Asia and the Middle East.
The way I look at it is we are coming to the end of the fiat currency era. And if you look at the politics today in this respect are very, very similar to what they were in Germany between 1918 and 1923. And, the end result of that is that priced in dollars, gold goes to infinity. It's not gold going up, it's the dollar going down and becoming completely worthless.
Exactly.
So that's where we're going. I would agree there is always uncertainty over the short term. And, whether it breaks out now or whether it consolidates more, whether a collapse in the equity bubble, which, as far as I'm concerned, is absolutely certain, because equities are wildly overvalued relative to bonds. Bond yields will rise. When that begins to happen, I think when you see the 10-year US Treasury note going through 4.75%, heading up towards 5 and beyond, that's going to be the moment, if not slightly before, that the bull market in equities will be dead. And I think the slide from there will be extremely nasty. As far as gold and silver are concerned, I think that the mining shares are more exposed to this than perhaps gold and silver. The reason I say that is because investors don't hold gold and silver. They really don't. I mean, it was fascinating. You sent through a thing to me earlier, Simon, looking at, the sort of Hartnell's survey of investment expectations and how gold is a crowded trade. I mean, this is rubbish. It's complete nonsense. I mean, it's one thing to say, well, gold looks like it's going higher, but it's another thing to actually own it. And if you don't believe me, look at the ownership of GLD and SLV. I mean, they haven't really gone up much. If they've gone up, it's because of value of the units rather than people actually buying new units being created. So, I mean, this is not a crowded trade. I mean, ownership, if you look at global portfolios, over $300 trillion around the world. Of that, invested in gold is roughly half of 1%. Just half of 1%. Is that a crowded trade? I don't think so. But what you could have, as to Simon's point, is that when you get a collapse in the equity market, I mean, basically, it's the excuse, if you like, to just get out of everything, irrespective of whether it's a good thing or not. And you can certainly see that someone, let us say, with profits on their mining shares, will use that as a source of funds to cover the losses on AI stocks, for example, going back to our subject. I mean, we saw that in the great financial crisis. And in the case of gold, yes, gold was a crowded trade then. Gold fell from $1,000 down to $680 over the course of the great financial crisis. It then subsequently went to $1,920. So that's, if it happens, it's a short-term effect. But I would argue that the degree to which gold ownership is embedded in portfolios is actually very, very minor. I think there could be an effect on the mining shares. But the other thing is, bear in mind that the pricing of gold and silver is no longer under our control. It's being controlled in China. That's where the market is, the physical market. And what we're seeing in derivatives at the moment is, I think you're seeing the beginning of the end of the derivative system, certainly as far as managing risk in commodities. That, I think, is on its way out. And that's starting with silver, because people are stuck in silver. They're short. We've got a delivery coming up. And I was looking at it this morning. There's something like 56,000 contracts standing for delivery, potentially. And I mean, that should wind down to towards the 26th, 27th of this month, which is the first day. And on that basis, you would think, well, that shouldn't be a problem. But there's only about 19,000 contracts, if you like, of registered silver available for delivery. It's going to be a close run thing. There could be a crisis in that. I think it gets avoided, because basically what happens is that if there isn't silver to deliver, then the shorts being forced to deliver will turn around and negotiate with the longs taking the silver and say, do you mind awfully if we pay you cash instead? And if so, how much do you want? So it'll be, I think that's the way in which this will actually happen. But you can see this is, we're seeing these cross currents are actually potentially very, very violent. And so you got to wear, a tin hat and make sure you keep your head down, basically. I think that moment is approaching, actually, in the next 4, 5, 6 weeks. It can't be far away. Can't be far away.
Economic fragility now intersects with geopolitical tension. Negotiations over Iran's nuclear program remain uncertain, with competing pressures inside Washington and regional security concerns influencing decision-making. A direct confrontation could disrupt Gulf energy infrastructure and threaten oil flows through the Strait of Hormuz, a choke point for global supply. Even limited military action would likely send shockwaves through oil markets and risk assets. In an environment already strained by debt, automation, and currency pressure, geopolitical escalation could become the catalyst that exposes deeper systemic cracks. Investors face not one risk, but multiple converging forces.
Yeah, they've done that before. I mean, it's been a sort of fairly regular feature, actually. So we're not breaking new ground in this sense. But the big question is, with such a shortage of physical silver, do you take cash or do you say, no, I want the silver? And I think that's the big issue. In the past, it's been quite simple. You could bribe me as a long quite easily. Just give me enough cash and I'll go away. Thank you very much. But now the silver is so demanded that price is not really all that relevant anymore. It's, there's a shortage of silver and that's got to be dealt with. And if I've stood for delivery, I'm going to want the silver and I don't want the cash. I mean, that's the way it is. There may be a level for some people, who perhaps have been punting it. But if you look at open interest in both the silver contract and the gold contract, there is virtually no speculation in there. There are not people who will go and stand for delivery and say, right, okay, I'll take cash, and this is my starting bid or what. No, I mean, that's the people to do that. They're not there. That's not what the market is now. So it's going to be interesting. Very, very interesting.
Simon, I know your take on the precious metals is what it is, but do you also share Alasdair's sentiment there as it relates to
completely. I think any shakeout that we have lays the foundations for the next move up. And we've got the DXY at 51 in 28, 29. That tells you gold is going to be at least $10,000. At least.
Well, you also had this one guy take up a huge bet. This mysterious guy take up a huge bet on gold prices. He bought like 11,000 contracts of gold call options at $15,000. So that would effectively be a 3x in gold this year, is what he bet on. Have you guys seen this story?
No, I haven't seen it.
Nor me.
I think that's it doesn't sound right, actually. It really doesn't. I mean, unless what I could see is someone taking a position of that sort, where they're short, trying to protect themselves from a real collapse, if you like, in the currency, or if you like, in market terms, a gold price which would otherwise just completely wipe them out. But that sort of capping, using options to cap, will be more like, sort of say $6,000, not 15. I mean, it doesn't make any sense to me at all.